All right. Hey, everyone. It's Investment Tuesday, and it's Paul here, ready with this is a packed Investment Tuesday. And yeah, all those warnings like, hey, watch out, euphoria. People are, in la la land. And we saw some price action, right? On it started on Wednesday, went into Friday, and Friday, was that classic what they say, right? It's the escalator up and the elevator down, right? A week's worth of gains are gone like that. And that's what happens really in markets which are incredibly bid up, where everyone has crowded into very similar trades. And what's going to happen next? What is going to happen next? Well, we are going to cover that. And then we are going to cover something that I think every person should think about and consider. I'm going to lay out this scenario, and people are going to be like, Paul, you are whacked. You are crazy. But hey, right? You see, the thing is, right, when you think of these things and you can put together a case for this, and if you keep it to yourself because, oh, you're so afraid to tell the world, oh, what if I might be wrong? You know what? Yeah, there's people wrong there every day. You know what? It's up to you. But I want to present this to you because I've been watching what is going on between President Trump, Jerome Powell, Federal Reserve. We just had like a Federal Reserve governor resign over the weekend. There was like a dissent in the vote, which is the first time in 30 years. Two governors dissented from Chairman Powell's decision to hold interest rates where they were. This is a major brouhaha that is brewing that has big implications for all assets. And I'm going to say that, as usual, my point of view is not what the market believes, and is not what I think you're going to find too many places. And those of you following me on X will maybe have a sense of where I'm going. But okay, let us do all of the usual disclaimers and disclosures. We got to keep the lawyers happy, right? They got to be fed and paid. So this video and the content from ATG Digital is not investment or financial advice. It is presented to you as my opinion, our view, our take on the world. Use it as information, engagement, and entertainment. Whatever you choose to do with it, it is your responsibility because it is your money. Next, all ATG Digital content may contain errors, oversights, or mistakes. Understand that investment operations, buying or selling a stock, crypto, options, anything to do with the markets, they have significant risk and can lead to the loss of your principal. Bottom line, you can lose money. Next, I, the owners, employees, contractors of ATG Digital, own, trade, transact the securities that are mentioned in this video and all content from ATG Digital. We do not take money from company managements that often, will ask YouTubers and other influencers, hey, we will pay you. Can you recommend our stock? We do not take money from those folks. We do not take money from crypto token promoters. A lot of those out there wanting, you to, they're like, hey, go buy this crypto token. We don't do that either. So for better and for worse, for gain and for loss, what you get is our independent, unique point of view. Here are some of the content things that we publish on a regular basis. We have the Substack that goes out on every market day, a podcast that is on Spotify called Bald Man Speculating. And then, of course, I am on YouTube along with my colleagues, Dean and Dan. You will find their videos on our channel. Social media, I am very active on X. Dean and the team post on my behalf on Facebook and Instagram from time to time. Check all those places out. We are informative and entertaining, and we try to keep you, of course, engaged with the markets as best as you can. If you would like to support this channel, you like the content that you see, then you can go and subscribe to this channel, join and become a member. You'll see that little black, let me go find this black thing here, subscribe, or you can go here and you can see we have a number of people that have subscribed. So you do just click there and you can join this channel and get access to membership perks. The biggest one of which is that you get early exclusive access to my videos. I believe you'll get it. I record these on Sunday and they'll come out. If you're a channel member, you'll get them on Monday. And then, of course, we publish it for free to everyone else. Then if that's not what you would like, instead, you can get a subscription to ATG Digital. We've got many different subscription tiers, which gives you various different benefits, various different features. You go to atgdigital.media. That's what the website will look like. Please make sure that it is our website. There are many scams. There are all kinds of nonsense that happens in the world. Make sure it says that exactly, not just that it looks like that. It says atgdigital.media, because people can copy websites and there's a lot of scams out there. So please be careful. But if you'd like to get a membership, which gives you what? Well, stock picks, updates, macro strategy. We have weekly updates. We have trades that go out. It's I think for the base rate of $9.99. That's a pretty good deal in my judgment. All right. So go check that out. All right. Let's quickly go through what is the right word? What's happening, right? I think retail and individual investors are very caught up in price and generally seek out information that confirms what they're thinking. And if they find something that disconfirms it, they'll be like, oh, no, but my portfolio is going up. And yeah, sure, it's one day, but I'm going to walk you through what I'm seeing. And then we can, sort of take it from there. And I will lead you down to, what I believe, the conclusion is, if you will, right? Okay. So this is a chart of the NASDAQ composite. The NASDAQ composite is is every stock that trades on the NASDAQ exchange, right? So in case you did not know, there are two exchanges in the United States, right? One is the NASDAQ Stock Exchange. One is the New York Stock Exchange. Two exchanges. And the world's biggest stocks, every stock has to trade on one of them. And the NASDAQ has become, the most valuable exchange, by market capitalization. All the big tech companies trade there. So, what trades over there, has a big impact. And I just put these up. I could have put the NASDAQ 100. It would show the same thing. And the S&P 500, in case you're unaware, that is a portfolio of 500 of the biggest stocks that trade in the United States across both exchanges, right? So what you'll see is that, we have this market peak on July 28th, and now we've seen a drop of 2 or 3% for these, indices, portfolios, benchmarks, what you call it. Of course, the individual stocks, you'd have been hit harder, 5%, 7%, maybe 10%. And what you'll see, and we'll just focus on, I'm going to actually take the NASDAQ composite now. Oh, I was going to take the NASDAQ composite away, but I don't think I can actually do that. But what you can see here is, what I was talking about, escalator up and elevator down, you're back to, for the S&P 500, you're getting back to where we were in April. In other words, the last 2 or 3 weeks of bid ups kind of have, suddenly poof, gone. Why? What's going on? All right. I go back to what I laid out for you and have been laying out for you for some time, which is that, in my opinion, what really is freaking out the market is a mixture of sort of things, which is represented best by tracking long-term bonds. Long-term bonds meaning the 30-year bond issued by the U.S. government, the 10-year bond issued by the U.S. government, and this orange line here. I'm going to actually make this a little bit simpler. Let me just remove some of these things and make it simpler. This orange line here is something called the MOVE index. And what it does is that it responds to volatility in U.S. Treasury bonds. So when the prices of those bonds are swinging around, you'll see this orange line starting to move up. So you'll see here, if for comparison, this is the Liberation Day. Yeah, April 7th is Liberation Day, and you can see into it. Treasury prices are swinging wildly up and down. The red line, by the way, is short-term interest rates, which more or less, I use as a proxy because it approximates to the one interest rate that the Federal Reserve actually controls. Many of you are under the impression that the Federal Reserve controls all interest rates. That is not true. It actually only controls one interest rate, which is a very short-term interest rate. Everything else is set by markets. In other words, demand and supply, people buying and selling. All right. So you'll see, Liberation Day, huge volatility in Treasury markets. And what happened during that time was initially there was the reaction that everyone expected, which is that interest rates went down. When interest rates go down, bond prices go up. But then there was a reversal. And suddenly long-term interest rates, the 10-year bond, 30-year bond, they reversed themselves. And interest rates went up and bond prices went down. And I can tell you that that was a shock, surprise to many people in the markets that felt that, into a panic, into a potential crisis, people would, there would be a flight to safety, which for the better part of, I'll say 30 or 40 years, flight to safety meant you went and bought bonds issued by the U.S. government, right? I mean, you'd buy the 10-year bond, you'd buy the 30-year bond. Money would just flood in there. So this is a shock to markets, a shock to the system. Now, many people will be like, well, maybe it was a one-time thing. Maybe, I don't really think so. I think there is an enormous concern among bond investors about inflation. They do not believe that inflation is under control. And it's going to lead to the second part of this YouTube video where I talk about the Trump, Powell, Fed saga and why this really becomes a central element to what I'm going to talk about. All right, but back to sort of like markets and what's going on this week. So this is a chart that shows you the number of 52-week highs and lows on the NASDAQ stock market. Remember, there are two markets in the United States, the NASDAQ and the New York Stock Exchange. And last week, I told you that this enormous rally post the Liberation Day panic, crash, whatever you call it, right, has been very thin. In other words, there's not a lot of stocks making new 52-week highs. It has been getting thinner and thinner and thinner. And then on Friday, we actually saw again, in other words, there were way more 52-week lows than there were highs. Why is that important? Well, I mean, if you're confident, you will bid up, lots of stocks to 52-week highs. If the economic environment, the financial environment is very good, a lot of companies would be bid up because investors have very positive expectations for the future and they will bid price up. So when you see a fairly thin number of 52-week highs and lows, It tells you that it's a very narrow market. Very few stocks are driving these indices higher, whether it be the S&P 500, NASDAQ Composite, the NASDAQ 100, whatever index you're on. Very few stocks are actually, pushing these higher. In other words, the vast majority of companies are not participating. However, if you're unaware, you may think it's great. We've had record highs. It must be a great, time for all stocks. Not true. And that has been especially true over the last, 3 months. This post-Liberation Day, sort of like this recovery, which has taken us to new highs, has been especially true. Very, very thin. And it's not just for the NASDAQ. It is also true for the New York Stock Exchange. And I am just going to make sure that these charts are set by the time I show these to you. And here we go. All right. This is the 52-week highs and lows for the New York Stock Exchange. And you'll see again, this is the Liberation Day panic right here. The big, big red. In other words, just mass panic. People selling anything for any price. Just get me out. I want out. All right. And then in the recovery, you have very few stocks participating. And there's a good reason for that. In other words, I'll show you something in a second. Okay. Just keep this in mind. Why, there's so few stocks participating. But one more market signal I just want to point you to that you can track yourself. This is the put-call ratio. All right. Okay. What's the purpose of this? Right. I mean, generally speaking, the market is filled with optimists who are buying calls. What are calls? So, I mean, calls are a bet on rising prices, right? I mean, people are super bullish on NVIDIA. They're like, well, I can make, okay money on NVIDIA, but if I buy a call, I'm controlling 100 shares. And now I can make even more money, all right? A put is the reverse, all right? A put means that you're betting on the price going down, and if you're, you have that point of view, you buy a put. But generally speaking, markets are bullish, especially, after a 5-year run. And generally there's, more calls bought than put. So it's something that you track that, when do people, tend to buy puts after a crash? Why? Well, I mean, it's there, it's right, top of mind. So you'll see here, when did people load up on puts? In other words, bets to go down? Well, after the, as the Liberation Day panic was sort of building up, that was one thing. If I go put this back to, let's say 2020, I don't know, I'll put this back 10 years. And you'll see that, here is, 2020, that's the bottom of the COVID crash, people loading up on puts. Equally, but harder to see is people, in 2021, as prices go high, what you tend to find is that people are just loading up on calls. And at first that's profitable, but eventually, markets get overbid up. There's simply going to be a point where there's too much supply. And so if you look at what, we have been going through for, let's say, on a 1-year basis, you can see that on Thursday, the demand for puts is rising. And you may think, well, Paul, that must be good, right? That must be a peak. Well, my experience is this was that when it first starts rising, that's a bad sign. It's like after a period of big rises or a gigantic spike up, that is often a sign that, okay, the bottom's in, and there's now the reverse thing. In other words, people have sold out, and now any small demand can push prices higher. So last set of information, which is that the reason for the thin advance, right? Remember, I was talking about the number of 52-week highs and how it's a very, very small number, both on the NASDAQ and the New York Stock Exchange. Why is it so high? Well, one of the reasons is that this rally, the post-Liberation Day rally, has been dominated by retail individual investors. One of the signals that that's true is margin debt, which is blowing out. It's retail investors that will often borrow against their portfolios at highs. Why? Because, well, they've got a lot of profits and they think, well, how can I make money faster? So yeah, hey, look, my broker will lend me money against my Nvidia stock, against my Meta stock. Let me borrow some, and generally they end up buying the same thing that is making them money. So people keep loading up on the same thing. Another signal that most individual investors would not know, not care about, is the spreads between junk bonds and investment grade bonds, which at peaks, near peaks, are very, very thin. In other words, the difference between buying, the bond of a company that's, AAA rated and really is never really going to have a problem paying their debt back, and that of a company that's going to struggle to pay their debt back is just very, very small. And what it points to is very high risk taking in the markets. And you can see here that we're very low, which tells me, in this X post, I say, people are in la la land over there. So that's another market turning point, top signal. Another is enormous market concentration. The stock won't surprise anybody. It's Nvidia, which is now 8% of the S&P 500. Now, many of you will be like, well, 8%, what's the big deal? There's 500 stocks in the S&P 500. Remember, it's an index benchmark portfolio of 500 stocks, right? If one stock has 8%, like, well, what's in the remaining 499? Well, it's even worse than that, because if you go and look it up, something like 10 stocks in the S&P 500 represent 40% of the index. 10 represent 40. So the remaining 490 or 60%. In other words, the smallest ones make almost no difference. And this is another thing that you often see at market peaks, which is extraordinarily high concentration. Why? Because retail investors have loaded up on the same stock and keep bidding it higher. And more evidence that that retail investors have been the ones pushing stock prices higher. They're not particularly focused on valuations. For them, what matters is, hey, the price is moving higher. I want to buy more of that. And this post here from Lance Roberts shows that same thing. Retail activity, has been very, very strong. Okay. Bottom line, to sort of putting all this together, that in my judgment, and I know this is going to be an unpopular view, people never like to be told that a party is coming to an end. We all like to see our investment portfolios rising forever. But in my judgment, tariff troubles are coming. The Liberation Day panic was really about, people thought that Trump, was going to actually implement 145% tariffs, and it was all going to happen like, in a month. And in that scenario, trade around the world would collapse very quickly. He sort of like pulled that back in and slowed the process down. But ultimately, tariffs are still coming. And yeah, it's not 145%. However, on average, it's between 15 to 20%, right? That is not a small number when you're coming from nothing. In other words, you're going from, almost near zero, maybe marginally 1 or 2% to 20%. That's a fairly big number, and someone will have to absorb that. There's only 3 parties that can absorb that.
There's a new bull market in town, but it won't favor the timid or those smitten by old market darlings. No, this bull market is for the bold, those willing to ride new horses into the sunset. We would know. This ain't our first rodeo. To grab the bull market by the horns, get your Trade War Survival Guide available in the description of this video.
The customer, which would, happen from companies raising prices. The supplier, who, for whatever reason, they're like, well, I got to run my factory. I got to pay, my folks. And, and I've got enough margin that I'll eat it. Or else it's the company that sells the product, and they have to make the same decision. In other words, I do not want to lose or potentially lose market share or customers, which, anytime you lift prices, people, will generally, in most scenarios, start to look for something that is cheaper, maybe consider delaying their consumption. And as a result, you can lose a customer. So companies are, while they'd like to constantly raise prices, customers, willing to shop around, look for cheaper things, look for alternatives, look for substitutes, act like, like a way that, to tamp all this down. So my view is that tariffs, at least at first, are going to end up being a tax on corporate profits. All right, now I'm going to quickly just show you a chart that I've shown before from Wolf Street, which is a publication that I read a lot and highly recommend. You can see that corporate profits are at record highs from 2020 to 2025. They have doubled. That may not seem like a great deal, but then you go look at between 2008 and 2020, and you're like, okay, like that's a big deal. So companies are flush. Companies are flush with profits, right? So that tells me that of the three parties, the party that is most likely to absorb the tariff hit is going to be the company that is generating the greatest profits, because they've squeezed the supplier, they've squeezed the customer. Yeah, so they can try to attempt to raise prices some more. However, the customers will rebel. All right, I mean, they'll be like, no, I'm going to go to a competitor that costs a little bit less. I'm going to defer my consumption. I'm going to, substitute this with something else. So bottom line, tariffs by design are going to reduce consumption of imports. And in a, globalized world, where companies that dominate the S&P 500, they have production all around the world. As they bring all these different parts in back to the United States, they pay different tariff rates. All right. So as those prices, are up, they will for sure try to pass them on, but they'll likely fail in many cases. And in other cases, companies themselves will be like, well, I don't want to deal with this. So they're like, well, how do I avoid tariffs? Well, you increase your production and manufacturing in the United States means you got to essentially move your production over here, which is a multi-year process. It's not going to happen in a day. It won't happen in a week. Won't happen in stock market time, right? I mean, in the stock market, everything can happen in a day. A company can go from a loser to incredible, market superstar. But the reality in life is that things take time. So companies, they may be like, I don't really want to be importing all these things, but they got to go find the land. They got to, go build a factory. Then they go optimize the factory. They got to build a distribution system in the United States. All these things are going to be complicated and take time. So in the meantime, you've got these record profits. And then I'm sure companies will try to raise prices, but in my opinion, it's going to fail. Why? Well, because I showed you this tab showing the profits of these companies. Now, why do they have those big profits? Well, because in 2020, 2021, 2022, and even some part of 2023, companies were increasing prices on their customers endlessly. Why? Well, there wasn't enough supply, so that was one issue. Second, remember, we got money flowing out from the government, right? Stimmy checks. The Federal Reserve has reduced interest rates. In other words, everyone's flush with cash, right? In that environment, we are much less likely to fight price increases. They're like, what's the big deal? I got $3,000 from the government, let's spend. But we're not in that scenario anymore. We're just not in that scenario anymore. And now, given a choice between losing market share or reducing profits, and this is important, we're not talking about, companies are not going to go from record profits to losing money. They're still going to make plenty of money. It just won't be more than last year, right? So, they're going to end up eating these tariffs. And the companies that choose price increases to pass on the tariffs to customers, there'll be enough companies that don't do that. So they will lose market share to companies that don't increase prices. And then there are companies that, sort of like have been anticipating some of this and have, started to move production over. They will have, marginally cheaper prices and they will take market share. But bottom line is that overall, given the state of play, if you will, the vast majority of companies didn't anticipate that we were going to have tariffs, didn't anticipate that, in 2025 and then for the foreseeable future, you wanted to be on the other side of globalization. You didn't want, to have 70 factories scattered around the world in China, in Mexico, in Eastern Europe, and, every different place. You wanted them, I said most people didn't, which means, their costs are going up, which means their profit margins are going down unless they can pass on the price increases. Bottom line, you're going to have lower sales growth because some companies for sure will try to increase their prices because they have no choice. Their sales will go down as customers choose somebody else. And the ones that eat it will have lower profit margins, which would lead to lower valuations. Bottom line, I don't think that this, which you're seeing, right, in the markets, I don't think this is this is going to be a 1 day thing, a 1 week thing. Now, I'm not saying this is going to go down in a straight line, but essentially, we had the Liberation Day panic low, and then we went, nearly 35% higher in the space of 3 months. And in between, there was all this, we didn't really have any major, reason for why suddenly stocks should be higher. There's earnings didn't come through, sales didn't come through. And remember, it's not the past that matters, it's the future, right? The value of a company is based on its future cash flows, right? That's the basis of a company. So we have, jumped higher in front of this tariff scenario, which we are going to be slowly and surely starting to discount, anticipate, and put into valuations, which for some companies is going to be lower sales growth, for some companies be lower profit margins. For some companies that obviously have manufacturing in the United States, have production in the United States, it will actually be a positive. But most of the companies that that dominate the S&P 500, that dominate the NASDAQ 100. Actually, let me just change this to the NASDAQ 100. I'll make it easier. They are sort of in the first category where they're going to be in one of those two camps, which is that lift price, lose market share, absorb tariffs, lose profit margin. And given the scale of profit margins, they got plenty to give. In that scenario, this, I believe, will continue for some period of time until we get to some price where people feel like, okay, we have discounted lower sales growth for the companies that are going to attempt to raise prices to offset tariffs. And we have discounted lower profit margins for the companies that, that at least for whatever, next 3 or 4 quarters, that are going to absorb the tariffs and take a hit to their profit margins. Okay, that's point number one. In other words, I don't think this is a 1 day thing. I don't think this is a 1 week thing. I think this is going to last for some period of time. Exactly how long, we don't know, because it depends on events, and as they unfold, it depends on company decisions, and also depends on how market prices adjust, right? But nonetheless, there is a lot more to be digested on tariffs that affect sales and earnings, which then will affect the cash flows of companies for a long period of time, that are not reflected in stock prices. All right. So I would still say that this is a time to be cautious. This is a time to be careful. This is a time to be thoughtful. And if you have liquidity needs, and especially if you are overweighted in all the very popular stocks, I mean, where will the selling come from? Well, I mean, yes, an overmargined, trader that owns too much, Nvidia, anybody else. I mean, once they are forced to sell, it can drive a cascade of selling. I'll just reiterate, in my judgment, this is a time to be careful. This is a time to be cautious. This is a time to be thoughtful about risk, and think about, like, hey, do I have too much stock? And if you do, consider the information that I'm providing you. I cannot tell you what to do. I am not your investment manager. I am not your financial advisor. I don't know what your risk level is. I don't know what your timeframes are, what your incomes are, what your ages are. Everyone has different risk levels, different thought, on things. If you have 20 years to go, you can be like, you know what, Paul, I don't really care. The S&P 500 has done 15% a year. Bet on that. Other people are like, well, I'm 2 years from retirement. Every person has to make that judgment for themselves. And obviously, we have to start with, well, is the information credible? Well, I have 30 plus years in this business. I've been through many, many market periods. So I will leave it there. All right. Next, and I'll go through the rest of this quickly. We have a brewing, I don't know what the right word is, crisis, problem, scenario that's going on, which is that, given President Trump's personality, which is like, wants to move like things now, right? I mean, this is not a president that thinks that he's got a lot of time. He thinks like, hey, there are important things that I want to do. There are important things that the folks that elect me, that I promised them I would do. And one of the things that he wants is lower interest rates. And he has not been shy. He has made it very clear that given a choice, he would fire Jerome Powell, who's the head of our central bank. The central bank sets one interest rate. It's called the Fed funds rate. But it's a very influential rate, and it can, it affects all kinds of rates from there. President Trump has said, hey, you know what, President Jerome Powell, you should resign. I'd like to fire you. And I think that something is going to happen. And we just had a Federal Reserve meeting in July where Jerome Powell, with two of the people that vote, right? There's like this group of Federal Reserve governors, right? And they take a vote on what to do about interest rates. And two people dissented. In other words, they disagreed with Jerome Powell. Now, disagreement in this place is a little, is very unusual, right? So this is the first time in 30 years, right, that we had two people disagree. So I think it's getting to the point where Jerome Powell's authority at the Federal Reserve is being diminished by the attacks on him, being diminished by the campaign to get him to leave. And I think that it is very likely that, by the time we have the next meeting, which is September, right? It happens, I think, the first couple of weeks, September. It's going to be a pivotal meeting, right? I think President Trump is going to, if Jerome Powell doesn't resign, I will say that there's a better than 50-50 shot that President Trump will actually be willing to precipitate a sort of a crisis. Generally speaking, presidents have not told Federal Reserve chair people what to do, right? I mean, it's, the idea is that the Federal Reserve is independent and they make their decisions based on information that's coming in, and that they are sort of like politically sort of like, exempt or immunized. In other words, our politics doesn't affect interest rate policy. Now, I mean, that's not, that's a very theoretical understanding. I mean, of course, politics affects everything, but at least presidents attempt to give the appearance of that. And they do it certainly far more quietly than President Trump has been doing it. So President Trump, on the other hand, is like, I want to fire this man. You should resign. You are the worst Federal Reserve chairman in history. I mean, I'm certainly not shy, which tells me that I don't think President Trump is going to wait until September. I mean, that's 2 months away. Just given what I'm seeing on social media from President Trump's team, there's an attempt to, talk about, the renovations at the Federal Reserve and this, that, and the other. President Trump is in a hurry. I don't think, he's so worried about the niceties. He's like, that'll all sort itself out. And he's certainly not going to wait until May of 2026, which is when Chairman Powell's term as Fed chair ends. So I believe that by September, Jerome Powell will resign, or else he'll be fired, which will precipitate, all kinds of things, or else he'll end up caving and giving President Trump what he wants, which is a cut in interest rates. And all of the three ultimately would lead to the same thing. It doesn't really matter how it happens, whether it's through resignation, firing, caving, because it would lead to the same thing, which is that the next person that follows Jerome Powell will do what President Trump wants him to do. If Jerome Powell does what President Trump wants him to do, he'll obviously be able to keep his job until May of 2026. But for the markets, these are all the same. It doesn't matter how it happens, which is that interest rates then would go down. And from the way I look at it, and this is contrarian, I suppose it is controversial, unconventional. I believe what will happen is long-term interest rates will blow out. Why? Well, we are in the era of inflation. We are not in the era that we were post the global financial crisis, which was from about 2000 and let's say 2008 to about 2021, 2022, 14 years, where generally we worried about deflation and we worried about recessions causing deflation. Now we are more worried about inflation and keeping that under control. And we worry less about, deflation certainly is not a concern. And recessions, to the extent that they might happen, well, they would dampen inflation. So from the perspective of bond investors, that's really not a problem. They're, like a recession would reduce demand, would reduce prices. For them, that's a good thing because their central concern is inflation. The bond market fears inflation. The bond market fears inflation. If you look at how bonds trade, they fear inflation. They fear inflation, and they feel already that long-term interest rates, which are somewhere, the 30-year bond is trading for 4.8, 4.9%, the 10-year for 4.4 something percent. It's not enough. It's not enough given how much we spend yearly, which is way over whatever we take in, how much debt we have, and how much money has been issued over the last 5 to 6 years as a result of COVID and everything else. So the bond market, like I'll say, is petrified about inflation. And I don't think that seeing Jerome Powell cave, which would be sort of like the easiest, resolution. Resign would be the second easiest resolution. The most sort of chaotic one would be a firing, because people argue as to whether or not a president has the authority to fire the Fed chairman. So there would be, of course, a political brouhaha around it, etc. One way or the other, what would happen is that investor confidence, global investor confidence in dollar denominated assets will sink. Right? I mean, because Fed independence is one of the reasons why the US dollar is seen as being different. Other central banks are highly influenced by politics. They essentially will do as they're told. They will, issue money, on demand, unconcerned about inflation, unconcerned about anything else. So Fed independence is something that is especially valued by global investors. I mean, because they feel the biggest impact because they've put their money in dollar assets, whether it be US dollars in cash, government bonds, or stocks. If the value of the dollar goes down against their currency, they get hit by that. We don't get hit by that because, of course, we spend our money in dollars. I mean, we earn in dollars. Everything is the same. But if you're in Europe, you're in Asia, in places like that, this is a big deal. And my view is that if I'm right, which is that President Trump is either going to get his way or else he's going to trigger a resignation as a result of the campaign to oust Jerome Powell, or else he's going to fire him. There will be a crisis of confidence because it will be seen that the Federal Reserve has lost some amount of its independence and that it is now more politically influenceable than it was before. And that will, I believe, trigger some amount of selling in US dollar assets. And because US assets dominate global portfolios, people in Europe, they own, dollars aplenty. They own bonds from the United States aplenty. They own stocks aplenty. It's true for Asia as well. Why? Well, because we have the most liquid markets. We've also had the best performing markets. And so they, over time, what's happened over this last 10, 15 years is that global portfolios are heavily, heavily weighted in US assets. And the largest amounts of this weight is, in, the safe assets, which is, the safest asset is bonds, right? I mean, treasury bonds. Why? Well, the US government is never going to default on treasury bonds. However, inflation will eat it away, and the value of the dollar can go down against some of these currencies. Now, the natural segue to this be like, okay, well, if the dollar maybe is going down, maybe we should, go and buy the euro. Maybe we should go and buy the Japanese yen, or maybe, the Chinese yuan. That would be a natural sort of thing in another time, right? And maybe 30 years ago, I might have thought this. But the truth is that, we can have our struggles about the Fed's independence, et cetera. But really, are you going to put your money in the Chinese yuan? I'm not. I don't really want my money to be, in a state where it's a one-party state where they could choose to do anything with it. The Japanese yen, I think Japan, is a great country, but they've got as many problems as we have. They've got enormous deficits, enormous debt, and they have a demographic problem that is much bigger than ours, which tells you that their troubles are not going away anytime soon. Europe has, their own struggles, which are similar, but different. But, they've got struggles and they're not going away. So there's no real place to go, right? Right? There's no place to go. Not actually true. Not actually true. My view is this, and like I said, it's contrarian, it is controversial, that instead of a flight to safety, which is what you might have had given very high asset prices, a potential brewing scenario, instead what you will have is a flight to Scarcity, flight to scarcity. What is a flight to scarcity? Well, flight to scarcity would be to assets that have known scarcity, that have known finiteness, that are not in control of, of states, not in control of central banks, and not influenceable by sort of like human actions. In other words, there is some limitation of some kind. Gold is obviously one of them. Silver is another one of them. Well, why those two in particular? Well, I mean, they are scarce just by the fact that there's just not as much there's not as much of it on Earth as much people would like, and it's difficult to find more. The supply of gold increases by 2%. Silver is more common, but it's still scarce. And in a scenario where you've got a lot of money that is in, currencies around the world where everybody's like, yeah, these are all some version of bad. Where can I go? Silver is a better alternative because, after mining silver for 100 plus years, we have a sense of its supply. We know how much more we can extract and at what price. And of course, silver also has industrial uses, which with the reindustrialization of America, with production moving back, there'd be more demand from silver over here. So gold, silver, then of course we have crypto, right? Bitcoin, 21 million supply. In this chart here that I'm showing, Bitcoin is in orange, of course. Purple is Ethereum. Gray is silver, and gold is gold. These are the four most obvious scarcity assets that I can think about that you don't have to work very hard. People might argue again about silver. People may argue about Ethereum, that there's not a defined limit. Yes, but there is a big difference between Ethereum and any state-issued currency, which is that you can go on the Ethereum blockchain at any time and see how many Ethereum are issued, what is the current inflation rate, where is all the current Ethereum that's been issued, where is it sitting. All that is more trackable, more monitorable than any state country issued currency. And in a period where people start to doubt things that previously held the old financial system together, like the independence of the Fed, this is a moment I believe that you could see money move in, and we wouldn't need a lot of money. Relative to US dollar cash markets, US dollar bond markets, stock markets, Bitcoin, Ethereum, truthfully, gold and silver, these are very small. So if you have a lot of people rushing out of one thing, right, which is, US dollar and let's say even other assets, and they rush into, these illiquid assets that are not built to take in, 100 billion in a day, 200 billion in a day. You know what's going to happen? Yeah, straight up. You're going to have some straight lines up in these scarcity assets. Old school investors will go for gold and silver. Newer investors will go for Bitcoin and Ethereum. And I only put Bitcoin and Ethereum, but I think generally cryptocurrencies, because people will say, well, hey, you can talk about all this, nonsense about cryptocurrencies. They're this, they're that. Still, I can know, what the inflation rate is. It is not fudgeable by governments, by some person that has some kind of agenda. It is trackable. It is monitorable in real time. I'd rather leave my money there. And I know for many people who are maybe a bit older, this seems like a nonsense idea, and that's fine. You can let it go through this year and out the other. I think for many young people, this is a very persuasive argument, given high deficits, high debt, and enormous money issuance. put it all together, I do not think that this is a time for aggressive buying. I think this is a time to continue to be cautious, continue to be careful, continue to be thoughtful. Portfolios at ATG Digital are somewhat conservatively positioned. We own a lot of utilities. One reason for that is that as people go to sell, I mean, what are they going to sell? Well, they're going to sell the 30-year bond. They're going to sell the 10-year bond. They're going to go short term. So, I mean, people will still, go to cash. But from there, what they're really doing is, selling out long duration assets. What is a long duration asset? Bottom line, it takes a lot of time to get your money back, right? If you lend the US government money for 30 years, yeah, I mean, you'll get your money back in 2055, all right? That's a long duration asset. Now, you gotta wait a long time. What are other long duration assets? Well, companies that don't have current cash flows and that need, things to work out over 10 or 15 years and where their peak sales are 10 or 20 years from now, like, some innovation companies that, really, they barely have a product. They don't really have sales. They have no real prospect to generate sales. They're going to need money from investors on a regular basis. Those are long duration assets as well. Why? Because, well, any large amount of sales is way out in the future. And in a scenario under inflation, those cash flows are worth less than cash today. So I believe that people will flock to companies that generate cash today and now, companies that have pricing power. I mean, that matters. Scarcity, as I mentioned. You put this together, you'd be in things like, energy, utility companies, because their electricity prices are going up. And, what are you going to do? Not pay the utility company, not have the AC on this summer? And, things that have natural inflation protection, those would be places where money would come in. Bottom line, a very much more complicated investment world is sort of like unfolding in 2025 and for the foreseeable future, at a period when certainly where stock prices are at all-time highs, reflecting all kinds of assumptions about the future, driven by, I think a lot of it is driven by AI euphoria. Part of it is just the markets have gone up so much over the last 5 years. Of course, it drives this like natural optimism. And then, we've got, of course, a lot of newer investors who simply are focused on price. And so, like this YouTube will have probably put people to sleep and caused a lot of people to be like, wow, that was a headache. I should have never listened. God, like this guy should really he needs to like really up. But look, this is the information as I see it. And that's what I feel my job is. My job is not to confirm what you're thinking. Is to be like, hey, here's the evidence. Let me present it. I'll present my conclusion. You can take my evidence and flip it and be like, that's not going to be what you say. It's hey, that's fine. This is my point of view based on my experience, based on my understanding, based on my knowledge. Use it how you will. If you would like to see how we're investing for this scenario, atgdigital.media, our portfolios have, a lot of these things. We have cryptocurrencies, we have gold, we have monopolies, and that benefit, from price increases and inflation. So check us out at atgdigital.media. Thank you for attending Investment Tuesday. It's Paul saying bye.